Hello, I'm Gregg Sanders, Group Publisher at QSR Magazine, and I'd like to welcome you to this webinar, The Recipe for Successful ACA Compliance. The IRS has been actively enforcing the Affordable Care Act, and quick service restaurants with multiple locations, a significant mix of full-time and part-time workers, and high turnover rates are particularly at risk of failing to comply with the healthcare law because of the complexity of the ACA. Quick serves with more than 50 full-time and full-time equivalent employees are required to make annual ACA filings to the IRS, and some operators have still not filed the required information because they don't realize they fall under the IRS requirements. In this program, we'll look at a recipe for quick serves to ensure they successfully comply with the ACA each year to avoid being assessed penalties by the IRS. One quick housekeeping note before we begin. We'll be answering audience questions at the end of the program, and we encourage you to submit your questions at any point during the presentation. You may do so by clicking the dialog box in the upper right corner of your screen, then clicking the Questions tab. All right, and now to begin, our presenter is Gregg Kasubuchi, Vice President at Trusaic. Gregg, welcome, and I will turn the program over to you.
Webinar, we will refer to each other as Gregg S and Gregg K. So I've been with Trusaic for over 15 years. I'm the Vice President of Business Development, and one of the unique positions that I get to see around this law is the inside workings of the IRS as we tackle this complex law for various clients and brokers. And so we see all the plan designs. So I've got some unique insights that I'd like to share with you to make sure that your businesses are protected from this law and doing the things that you ultimately need to do to be in compliance. So Trusaic was formerly known as First Capital Consulting. We're a consulting firm out of Los Angeles, California, and we really specialize in complex data and regulations and making sense of that information. There's a lot of dirty data in systems, and if you want to achieve regulatory compliance around the employer mandate, you really need someone that can understand that data, clean up that data, apply the complexities of this employer mandate in order to have proper visibility so that you know at the end of the year the returns that you file are accurate. We've also got a world-class net promoter score of 75. And so that's just some further proof of some of the things that we do with our clients. I'm going to begin with some acronyms. These are most of the common terms that are going to be used with the Affordable Care Act: full-time equivalents, part-time, applicable large employer, minimum essential coverage, minimum value, premium tax credits, employer shared responsibility payment, and limited non-assessment period. You will find these throughout the presentation. So to begin, I think it would help for everyone to understand, why do we have to file a 1095 and a 1094 when there is no more individual mandate law, or actually the individual mandate still exists, it's just the penalty is now 0. So I'd like to start with something called premium tax credits. So a premium tax credit is essentially a subsidy that will be given to any individual in the United States that buys health insurance through a state or federal exchange. So for states that complied with the Affordable Care Act, they expanded Medicaid essentially to 138%. So typically your blue states have Medicaid expansion. So if someone has the income level, as you see here, between this is household size and this is the income, they could actually make up to 400% of the federal poverty line, and they would receive what we call a premium tax credit. So those of you in blue states, if you fall between 138, you're going to get Medicaid. But those of you that are in probably more Republican states where they didn't expand Medicaid, unfortunately, your employees, if they fall within 138%, rather than getting Medicaid, they're going to get a premium tax credit. One important note, if you're in California, California is actually expanding their PTC all the way to 600% of the federal poverty line for 2020. So those of you with stores in California, single employee can make essentially just under $75,000. And if they go buy health insurance through a state or federal exchange, they will get a premium tax credit. And in this industry, I see about only 8% of the workforce take insurance, which means about 92% are declining your offers of insurance, and you have no idea what they are doing. So why is this important to understand? And what is the IRS doing with this information? Well, essentially, they are reconciling this to figure out which employees are wrongfully obtaining these. And so it's important to understand by state how many people do this. And mind you, this is 2019 numbers that come from the CMS. The CMS will release the 2020 numbers sometime around February or March each year. This is in a tax year when the individual mandate has been zeroed out. And these are the PTC by state. So you can see states like California, Florida, and Texas, we have large amounts of citizens that go obtain premium tax credits. The average amount that people get is $539 across the board a month in subsidized healthcare. So you can compare that to the plans that you offer and what you're charging the employee. And it's probably no wonder why they decline and they may end up getting subsidized healthcare. You have about just under 12 million people who buy insurance through these state or federal exchanges. And out of 12 million, about 9.7 are getting premium tax credits. And since I'm in California and we do have some of the largest enrollees, I always have California numbers here. In our state, we have about $470 is the average subsidy that a citizen in California gets when they go buy health insurance through the marketplace in our state. So that is the basis for this entire law. It's important to understand that because that triggers the penalties that we are all worried about. So I'm going to walk through the penalties. And the first penalty that everyone is worried about is I would consider it the hammer penalty. It's the 4980HA penalty. So the way this penalty gets triggered is if you fail to offer a minimum essential coverage plan to at least 95% of your ACA full-time employees and their dependents. So what does that mean? That means on a month-by-month basis, an employee that is full-time ACA-wise had to have been able to have enrolled themselves and their dependents in a plan, and you had to have met 95% cliff. If you do this and you meet 94.9%, you failed. And so what happens is if one of those employees in your organization goes and buys healthcare through the exchange, that will trigger this A penalty. So this is called the hammer penalty because for not meeting that 95% cliff, they will hammer you on a penalty for every full-time employee that month. So to just give you the numbers over the years, these are the excise tax penalties. It's important to note that excise tax penalties are not deductible and you cannot file bankruptcy, so they will follow you and the IRS will collect them. In 2020, heading to 2020, you're looking at about $21,000 per month in excise tax per 100 ACA full-time employees that you have. Again, this also assumes that the first 30 freebies have already been taken. So the IRS essentially gives you the first 30 free, and then the penalty kicks in. So on your 31st and above, that is where you start to pay this penalty. But it's about $21,000 per 100 full-time employees you have per month. So that is the A penalty. That is the hammer penalty. So let's say you offer an insurance plan, it's meeting minimal essential coverage, and you're doing that to 95% accuracy. Now the IRS wants to know that that insurance plan that you offer is not some garbage plan. It meets certain thresholds, meaning minimum value, and it's affordable. So the next penalty that you're worried about would be the 4980HB penalty. So the B penalty would be triggered if the plan is not a minimum value plan. So that's typically plans that have hospitalization coverage, preventative services, prescription, and it's affordable. So affordability generally means 9.5% of your household income. However, the IRS said, you as an employer, we understand you don't know household incomes. You only have the employee's income. So the IRS established safe harbor methods. And they said, if you use one of the three safe harbors, you will be safe. So if you don't charge more than generally 9.5%, and again, that number changes every year based on the index, of the federal poverty line or their rate of pay or W-2, then we will consider that an affordable offer and you will be in compliance if the plan is minimum value and affordable. That way, the employee cannot get a subsidy on the exchange. They should be taking your plans and you will avoid the B penalty. Now, in practicality, what happens? You make the offer, the employee declines it, and they may end up on the exchange. The exchange doesn't have checks and balances as to whether or not your plans were minimum value and affordable or whether you're doing it to 95%. And hence the filing of the 1095s at the end of the year, which we'll get to a little bit later, that gets reconciled to figure all of this out. One important note here for the restaurant industry, it is very difficult to use a W-2 safe harbor. So if you are using a W-2, I would strongly consider rethinking that safe harbor. You should all be using rate of pay. So what is the B penalty? So the B penalty is less of an issue because it's a per occurrence penalty. The employee has to be an ACA full-time employee. They have to have not been made an offer of minimum value or affordable coverage, and they would have to buy insurance from a state or federal exchange and qualify under that income that we just went over, the premium tax credit income levels of 400% of the FPL. And if they meet those criteria, then you will be penalized right now in 2020, $362.66, but on a per occurrence. So unlike the A penalty where you get hammered on every employee, this is only on the employee that obtains the subsidy. So A and B penalties are what most employers are concerned with around this law. So now that you know the penalties, how do you implement this program? Well, the Affordable Care Act is pretty simple in nature, right? You have an A and B penalty, you offer insurance, you offer to 95%, needs to meet minimum value and be affordable, but it's very complex in its application. So what you are doing annually and every month, annually, you are looking at what we call an employer aggregation. So if you have change in ownership percentages, if you're in doing mergers and acquisitions, then you are looking at the entities to figure out, are these entities grouped together for the purposes of the Affordable Care Act and reporting, or can they stand alone? So that is the very first step of this law, is to perform an employer aggregation and identify what we call your controlled groups. Then once you identify that, you know what groups of entities and employees to look at, and you aggregate or you can separate, and then you do what we call an applicable large employer test. You want to know, do you average 50 full-time and full-time equivalents? One of the things I do make note, I have seen lots of payroll systems spit out these calculations, and they are using their own made-up formulas, not approved by IRS. And so I would caution you not to rely on those systems unless you're using a very, very reputable payroll company. But I can tell you I've seen lots of wrong reports. So once you establish that you have 50 full-time and full-time equivalents, that means you are an applicable large employer, and now you have to deal with the employer mandate, and you're worried about those A and B penalties. So the next step would be to figure out what method are you going to use to measure your employees and essentially identify when an employee is ACA full-time and should be made that offer. And you have two methods approved by the IRS. You have the monthly method and you have the look-back measurement method. For high turnover industries, you want to control your healthcare costs. You want to control the number of employees that are going to be reported as full-time, the number of employees that you have to offer insurance. You're going to want to use the look-back measurement method, and that is a very complex method. Monthly method is very simple. It's for companies that are all full-time. Essentially, you work 130 hours in that month. You're full-time that month. You don't work 130 hours. You're not full-time that month. So it's a month-by-month calculation, whereas the look back kind of normalizes your workforce. You're measuring people over a period of time, and they have to average 130 hours a month or 30 hours a week before they become identified. So if you're going to use the look back, now you're talking about setting up what we call your standard measurement. So your standard measurement is something that you're going to annually do across your workforce. You might consider that your census for open enrollment. You want to know which employees are your stable employees that have been with you through the standard measurement and average 30 hours a week or 130 a month and are full-time for that open enrollment period. Then you have what we call an administrative period. That's the time that you get to actually do that calculation, shop for the insurance products, do the open enrollment for whatever effective date you're going to have that plan effective for. And after the standard measurement and the administrative period follows a stability period. So once that calculation is done, the employees are locked in for the remainder of the stability period, meaning their status is frozen based on that look back standard measurement. And regardless of the hours they worked during the stability period, they're frozen as either full-time or part-time based on that calculation. You also need to set up your initial measurement methods. So initial measurement methods are going to be for a new employee that you hired that is variable hour, meaning you can't accurately determine if that employee is going to work 30 hours or more. Their hours vary, therefore their variable hour. So you get to apply a measurement anywhere between 3 and 12 months to measure that employee and see if they actually average 30 hours a week or 130 a month. And then following that is an initial administrative period. Again, that's the time you get to do to look back, calculate those hours, make the offer if they are full-time. And then those employees are also in what we call a subsequent stability period. And that period can be locked in a minimum of 6 months all the way to the actual length of the initial measurement. So these are the complexities with the look back measurement method, but it is the method that a QSR or restaurant operator would want to use. So once you've defined your methods, you are now essentially doing monthly accounting work. You are obtaining all of the data that you need and putting it in essentially audit-ready format. Ideally, you're doing this monthly, not at the end of the year. So essentially, you're looking at time and attendance data, payroll data. You're looking at the plan, the benefit level data. Are the plans meeting minimal essential coverage? Are they minimum value? Is it affordable? What are your waiting periods? Again, it's important to note you cannot make a full-time employee wait more than 90 days for health coverage. And you got to remember some months have 31 days in it. So generally the rule on that would be the insurance is effective first following 60 days of employment. So you're looking at the health benefits data on an employee by employee level, like eligibility and enrollment. And you're essentially calculating your full-time and part-time status using all of that data, payroll, time and attendance, leave of absence records, to figure out on an employee by employee, month by month basis, what is their status and when do you need to make an offer, because that offer needs to cover 95% accuracy if you want to avoid that A penalty, and separately minimum value and must be affordable if you want to avoid the B penalty. You essentially do that every single month. You document, you store those records, and you repeat that all 12 months. The culmination of that would be the filing of the returns. So what kind of visibility do you want or should your systems have? Ideally, the KPIs that you're looking for are essentially your compliance percentage, right? You have all the buckets of your employees, active employees, how many employees are full-time versus part-time, how many employees are in measurements, are they averaging 30 hours, are they not averaging 30 hours, and essentially what we call limited non-assessment periods. These are essentially the time you are getting to measure people or they are waiting for insurance to be effective. It's a limited non-assessment. It means this employee may be full-time, may not be full-time, but whatever their status is, you cannot assess a penalty because we are essentially waiting to determine their status or they are waiting for insurance to take effect. And what that leads to is compliance percentage. So if you don't have visibility on this, then you're going into this law blind. And as I said, $21,000 per 100 full-time employees in excise tax per month, not something you want to file at the end of the year and realize you're out of compliance all 12 months. So again, 95%, right? You also want to know what is your B exposure. So if you're above 95%, there's no A penalty. You're meeting that threshold. But you may have B, right? Penalty. You could be offering to 95%, but maybe some of those offers are unaffordable, especially those of you in small groups that might have age-rated plans and have an older workforce. You want to know what that amount is, and you can correct those, right? So if you're looking at this month by month, then you have the ability to fix it each month and limit your exposure. So aside from that information, you also want to be looking at if you're not at 95%, that means you failed to make an offer. So you would want the data to know, okay, which employee should I have made an offer? And so if you're looking at this month by month, you can immediately make the offers. Let's say effective. Let's say you were had no missing offers in January, then you're supposed to make offers to 3 people, and that started dropping your compliance. And eventually you get to April where you have all these employees that you should have made offers to and you still haven't done it. Well, if this is getting close to 95%, you could immediately make an offer effective May 1st. And the minute you make that offer effective and you're back above 95%, you've eliminated that exposure to the A penalty. So again, why you're looking at this monthly. Obviously, you want to know every month which employees you need to make an offer to. So if you had this report, let's say in July, then you would know in June you need to make these offers, and you would want to have some sense of forecasting. What is the workload? What is the financial picture? How many employees do I need to make offers, maybe potentially next month and the following month? So essentially, these are all employees in measurements where their measurement isn't completed yet, but they are averaging 30 hours. And if the trend continues, they will eventually need an offer. And so you want to have some visibility into just the whole workload and financial picture there. Separately, in an industry where like 92% of your workforce declines the offer, you want to be proving that you made offers. So we always have to prove 2 things to the Internal Revenue Service. How do I prove that I made an offer to 95%? Well, we like to use an affidavit. When I go out and we make an offer, whether you have technology in place or you're doing it manually, many restaurants are doing it manually. You have store locations all over, maybe multiple states. It's hard to get to employees. And when you make an offer, you can't have them sign paperwork right then and there. You need to give them a reasonable amount of time to determine if they want to enroll in coverage or decline. So if you're relying on the carrier's waiver forms that are typically in the enrollment packages, well, now you're chasing down a workforce that generally declines. And so what we like to do is we like to use an affidavit. So the minute you make an offer, you're having the employee attest that they've received the offer. Again, because I need to prove 95% offers have been made. On the back end, you still want to collect that waiver, because if you did comply with the law, meaning the offer was minimum value, it was affordable, and that employee declined it, you want that to challenge the exchanges later on as the exchanges start to send out notices so that these employees can't go get these subsidies. And more importantly, they don't get a plaintiff attorney wondering why the IRS is going after all the subsidies and they can't remember 2 or 3 years ago that they declined the offer. You need the burden of proof is on you as the employer. And then essentially that rolls up into, ideally, in your audit files, you would want some sort of visibility as to how much documentation do I have that I can use to back this up and represent an audit. So some of that visibility is what you would get, the percentage of documentation. And if you're not at 100%, who am I missing documentation on? Again, you're just trying to prove 2 things. Prove that you offered coverage to 95%. Prove that they declined if they declined, and essentially the rest is in the documentation of your benefits, right? The plans that you're having, the rate sheets, the minimum value, all of that should be in the general plan setup that you have by your broker. So that is the visibility you want every month. Why? Because at the end of the year, you're going to prepare a 1095-C, right? So this is the employer's portion. And many employers wonder, why do we have to do this, right? And not to be confused with a B, 1095B. So issuers of insurance policies have to issue a 1095B. They are reporting to the IRS, essentially on a belly button or Social Security basis, which employees had health insurance for which month. And it's a simple X in the month in which someone was covered. You as an employer are identifying for the IRS which employees are full-time, right? Because if an employee is full-time for 1 or more months in the tax year, that means you should have made an offer of health coverage. And that offer should have also met minimum value and be affordable in order to avoid those A and B penalties. So you are preparing those returns to the IRS. And again, one of the things I'll note, I see a lot of payroll companies and other systems, not just limited payroll companies, but a lot of other vendors will prepare a form on essentially every employee in your organization. Not something you want to do. And I'll explain a little bit later, but you're essentially telling the story, right? Generally, so line 14 is always going to be filled out depending on what is in line 14. You may or may not have data in line 16, and you may or may not have data in line 15, but you're telling a story, right? The employee is not employed for my company, not employed in February. Oh, I hired this employee in March. I hired them as a part-time employee, and then maybe they started averaging hours, and maybe they became full-time in June. Full-time in June. Now an offer should be made and effective, within the proper waiting periods, and then the appropriate coding would follow, right? Whether those plans meet minimum value, minimal central coverage, the cost, and whether that employee enrolled or declined. That is the story you are telling the IRS. Why? Because the IRS, and when is that due, by the way? Sorry. So a few days ago, the IRS announced an extension again. So for the 2019 tax year, those 1095-C forms need to be furnished to only your ACA full-time employees by March 2nd. So originally it was January 31st. They have given you again another 30-day extension to about March 2nd. So these are employee disclosures. You're disclosing to the employee on that 1095-C form what you are going to submit to the Internal Revenue Service about their status and your offer of health coverage and whether or not they took it. Separately, once you distribute to the employees, you have to take that same set and you put on a summary form, a 1094, and you have to file that to the Internal Revenue Service. So if you have less than 250 1095-C forms, you can paper file that. That deadline would be February 28th. If you have 250 1095-C forms or greater, you must electronically file, and that deadline will be April 1st. If you miss the paper filing deadline, then you can e-file by April 1st to meet all of the good faith reporting. So what are the penalties for not preparing accurate returns, not meeting these deadlines, not furnishing them? Okay. So this is what the IRS gave good faith. The IRS has announced good faith effort for 2015 through 2019 tax years. So what good faith means is that if you make a good faith to prepare the 1095-Cs accurately, file those and furnish those on time, you will avoid these penalties, right? So there are certain penalties for not doing that. And there are certain caps. So if your gross receipts are less than 5 million, then these are the caps. If you're over, there are various caps on the returns based on revenue. The IRS is going after all of this. There are many clients that failed to file the returns, many vendors that failed to file on behalf of their clients, and the IRS is now sending these penalty letters out. And if you didn't make a good faith, these penalties will apply. The A and B penalties that we went over, those have always been the law of the land. There has never been any changes with that law since 2015, and the IRS has always been going after that. So what does the IRS do with that? We talked about the premium tax credits at the beginning. Your industry, 92% generally will decline the offer. Well, they want to reconcile those returns. They want to know how many of those people are wrongfully getting subsidies. So they built something called an Affordable Care Act compliance validation system. They released this system in about November of 2017. And essentially what it does is it takes the social security numbers of those forms and it just reconciles on an employee by employee, month by month basis with the exchange's returns. So those 9.72 million people in the United States that are buying insurance from a state or federal exchange, they are getting a 1095A series form. The B comes from the carrier and the C comes from the employer. And the social security number will get reconciled. And what is reported to the IRS is, here's my social. Here is whatever month I went and claimed and what amount of subsidy I got. Again, the average subsidy across those 9.72 is $539. Well, once the IRS gets all those returns, they are now running it through that ACV system to reconcile. And they're supposedly 4 outcomes. The first 2 are going to be bad for you as the employer. So the first outcome is they're going to reconcile and an employee gets a premium tax credit. It only takes 1. They're going to look at your forms and they're going to say, did you meet 95% in the month in which an employee got a premium tax credit? If you did not, then that's that A penalty. You're going to get a penalty notice. It's going to apply to every full-time employee or every form that you issued for that month that's showing full-time in your organization. Or they're going to say, hey, you actually did make offers that month to 95%. But for that employee that got this subsidy, that offer was not minimum value or affordable. That would be the B penalty. So these are all automated now through that ACV system. The IRS is only in the 2017 tax year right now. They have also communicated that they will probably be going through the 2017 audits. They won't finish up until maybe September of next year. So they're just beginning the beginning process. So if you haven't gotten a notice by now, it's probably because they either missed you in the 15 or 16 because they had a lot of problems with their systems, or they haven't gotten to it in 2017 if you're out of compliance. The other two results essentially would be the employee was not entitled. So the employee could go get a subsidy. They could look at your return. Your return is going to show that they're full-time, that you made an offer. You're making offers to 95%, and to that specific employee that got a subsidy, your offer was also minimum value and affordable. So the IRS knows, hey, if an employee had access to an employer plan, they should have taken that. They are not allowed to get a subsidy, but they do it anyways. Again, mind your workforce, 92% decline. They go get a subsidy anyways. So the IRS will know, hey, you should have taken the employer plan. They're going to go claw that subsidy back from the employee. And in fact, that is what is happening. That is why those two documentations, proof you made the offer, proof the employee declined it, so that when the IRS claws that subsidy back in, let's say 2017, you can show that, right? You can say, hey, look, we offered you. Here's the proof we offered you. Here's the proof you declined it. You can't blame me for wrongfully getting subsidies. And then the fourth result would be you're in compliance with the law. The employee is not full-time and they are eligible for the subsidy. Well, then you and I pay for that as taxpayers. These are legitimate subsidies that should be given to employees. So essentially, that is the reasoning behind you as an employer having to deal with these reporting requirements, even when the individual mandate has been zeroed out. And this is not going away. It's probably going to get tougher. So here are some facts. The tax administration inspector, the tax inspector general for tax administration, audits the IRS roughly annually. And they make recommendations on the IRS's ability to enforce this law. So out of that comes these numbers. So when they released that ACV system in November 2017, they started with the 2015 tax year. And in 2015, they reported that about 400, just under 500,000 returns were filed, but it comprised of about 300, just under 318,000 employers, right? Some employers have multiple EINs, they file multiple returns. And out of that, they identified just under 50,000 of them were not in compliance. So that's about 1 in 9 filers. They sent assessments out totaling about $4.5 billion. Now, a lot of this was incorrect. Some employers were actually in compliance. It's just people didn't know how to fill out tax returns, so they filed out of compliance. But there are also many people that are paying penalties. They've also acknowledged that many people, or that the system was in its infancy. They didn't have all their algorithms, and they actually moved all of that logic into their enterprise platform. And so they had missed a lot of employers. They essentially just moved on. They did the same thing through 2016. About 40,000 filers got notices in 16. And we think in 17, we think it's going to be a lot larger based on the volume of notices we are seeing across the nation that we're responding to for people that come to us for help. It's also important to note that in 2019, they started also sending penalty letters for those who failed to file or filed late. Those are those reporting penalties, roughly about $260 per return. And remember, you have 2 returns, one to the employee and one sent to the IRS. So it's really about $520, and those go up every year. Right now, they're about $270. With the individual mandate being zeroed out by the administration, you have various states that are picking up state mandates. So states like Massachusetts, New Jersey, Vermont, DC, and in fact, California, the individual mandate is going to affect January 1 for California. So it's going to get more complex for larger organizations that are multi-state to deal with both the federal law and each individual state's reporting. That's coming down. So what do you do next, right? Well, you definitely want to pay attention and not treat this as an end of the year W-2 type project, right? So what I would recommend is you want to confirm your employer aggregation. If you have multiple entities, if you've gone through some M&A, that is step one. What is your control group? Because that allows you to figure out which employees you need to group together and perform ALE testing on, right? So some of you, you're well over 50, doesn't apply, the law applies, but some of you border, and it's really important if you're borderline 50 full-time equivalents, you have that calculation done and you know for sure because the non-reporting can be substantial. If you haven't filed, now's the time to file and get back into compliance. I would recommend reviewing all of your returns that were filed, the 1094, 1095s, to make sure they are accurate and what you filed doesn't lead to exposure so that you could correct those returns to avoid these penalty letters and take advantage of the good faith. The good faith provision applies if you correct those as reasonably possible. I recommend, since the IRS is on 2017, you might only need to look at 2017 and 18 returns. And as you're getting into this right now for 2019, you might want to look at 2019. The biggest thing I see is you also want to get from your vendor the receipt ID and the filing status. And this is where I see a lot of failure in the market. Every vendor that files these electronically to the IRS, they get a date and time stamp back, and that's the receipt ID on the date and time that they filed. And then there's a status. The IRS either gives you an accepted status, an accepted with errors, or a rejected status. If you've got a rejected status, you didn't file. And so you need to correct that and file. And so I find many vendors didn't realize this, and employers don't even have this level of visibility. So that's something I would request from all your vendors. You definitely want copies of your 1095Cs and 1094s. You need to maintain all these records for 7 years because, again, the IRS is on 17. Your employees, aren't going to know what's going on. And so you need to have that proof. So I would evaluate all of your plan designs and what your business drivers are around healthcare. What are you trying to do? Are you trying to comply with the cheapest, way possible with this law? Do you actually use benefits to recruit and retain? There's so many moving parts. You really need someone more than your insurance broker that can understand what the IRS is doing, that can understand the accounting, that can understand all the insurance and put it all together that makes sense for your business needs. So doing that by reevaluating your insurance plans, that'll give you a good understanding. I typically don't like to tie the largest risk, which is the A penalty, the hammer penalty. I don't like to tie that to the toughest insurance product for your industry, which is that minimum value plan, right? A lot of brokers are going to, give you the minimum value plan. You have to make it affordable, meaning you can't charge an employee more than 9.5%. So you're going to bear the bulk of that premium. And you're going to deal with the industry's carriers' participation requirements. Generally, they want 50% enrollment or greater. And again, I don't see more than 8% enrollment in these, hourly workforce industries. Those premiums generally increase year over year. And it's just a hard insurance product to put in place. And many clients of ours that have come to us have said, well, we went through the motions, we made the offers, we collected declinations, we couldn't get employees to take the plan, and the carrier denied us for not meeting those participations, and that leads to huge A penalty risk. So I would rethink the architecture of those, how you're using insurance to comply with this law, and not to put any bad mouthing the brokers, but there's huge conflict of interest in the industry. Aside from the commissions that brokers get, you have huge carrier incentives to put as much bulk of business with one carrier because they give them these lavish trips at the end of the year. So there's just a lot of conflict of interest in the industry. So I recommend, you seek advice from multiple sources and not just relying on the insurance industry. Again, this is excise tax IRS. It just happens to be an offer of an insurance product. With that being said, how do we help? Well, we do free ALE testing for you. we do free reviews of what you filed. So I have the ability to take a look at the 1094s and 1095s that your vendors filed for you. And I would recommend getting 17 and 18 returns and 19 as you go into that. And I could break down every aspect of that return for you within 24 hours. I could tell you what your monthly compliance percentage is that you sent to the IRS and whether or not you were over 95%. I could tell you how many coding errors. I could tell you what your A and B penalty is month by month. That gives you some understanding of your processes if it's leading to what we call a garbage in, garbage out into these systems, or whether or not you need some more expert help to navigate that data, understand the law, clean it up, and defend this before the IRS. You can also keep current on the ACA Times. You can register through the ACA Times. And with that, I will turn it back over to Gregg S. for Q&A.
All right. Thank you so much, Gregg K. We really appreciate that. So as Gregg K. said, we are going to turn to audience questions now. And just as a reminder, you can submit a question by clicking on the dialog box in the upper right corner of your screen and then click on the questions tab. Gregg K., we do have a few queued up already, so I'll launch into those now. First, if we made offers of coverage for health insurance and collected all waivers, but didn't meet the carrier participation requirements, will we still owe penalties? It's not our fault. The carrier denied us.
Yeah, so I think the issue with that is in the IRS's views is they're going to say you should have complied with the carrier underwriting guidelines. You actually don't have a plan in place, so effectively there is no plan an employee could enroll in and have coverage to cover all 12 months of the tax year. I think also as employees become eligible throughout the year, what did you offer them? If you only did it at the beginning of the year for open enrollment, but then didn't get the plan in place. So I don't know if that's going to fly in the eyes of the IRS. I think that's something that may, go through the courts. But I think their eyes is they're going to view it as you should have found a way to meet the participation and get a plan in place. And there are solutions out there for low participating industries like the QSR industry. Yeah. So short answer is I don't think you're going to be in compliance with that.
All right. Fair enough. Next question. Are there any payroll companies that do reporting correctly?
Of course, so I don't look at it as, there are some that are better than others, but I look at it as just, it's the wrong solution for the wrong industry, right? So when you're talking about one of the most complex tax laws, and most companies have given this to HR departments, and then you're giving them a software system. Well, those things demo well. It's fine and great. Look, I can, it's applicant tracking, onboarding, payroll. It can average hours. It can make an offer, and it can take that data and prepare. But implementing that is, much more complicated. These systems aren't going to tell you, well, do I need to continue to make offers if this employee's on FMLA and still out on unpaid leave? Am I part of a control group? This employee was termed and rehired. Do I start the measurement over? Do I need to back out the gap of unemployment? So all these, facts and circumstances, I think, create complexities and making your HR really has to be a expert, right? On a level of like a CPA. Like a CPA uses tax software. You don't circumvent the CPA and go buy tax software just because you can throw in all your accounting and hit submit. Well, so I just think I think it's just the wrong solution. Those type of solutions I think are for low risk, low complex clients. Everybody's full time. We make offers to everybody. Just aggregate the data, automate it, file it, it's accurate. And so I don't see it as bad or good vendors. I just think wrong product for the industry.
All right. Next question. What is the best way to be in compliance with the ACA?
Yeah, for like, again, there's a lot of varying facts and circumstances. I would say for a restaurant industry, when you're dealing with a high turnover, low income, low participating workforce, and your workforce is, spread out logistically challenged, I typically recommending offering an insurance product to every employee as part of new hire. And there are products out there that you can do that where it's 100% employee paid, so you don't bear any of the cost on that as an employer. That'll help shield you from the A penalty, and then you'll have to go the more traditional route for the ACA full-time employees with the minimum value if you want to avoid the B penalties. But I would just talk with somebody that understands how to architect all of the plans and all of the data, and just really put it together for you so then you can make proper business decisions.
All right, next question. What is the best safe harbor to use?
The best safe harbor is definitely going to be federal poverty line, but that means, in 2019, the employee wouldn't be charged more than basically $99.75 for their portion of healthcare. That's obviously the most expensive for an employer. So aside from the federal poverty line for a restaurant industry, it's going to be rate of pay. So you're going to just not charge the employee more than 9.5% of their rate of pay. That would be the best way. Again, W-2 is almost impossible to use for the industry. Typically, W-2 is going to be used for a very highly compensated employee, or like I would say, executive management team.
Okay. Next, we only offer coverage once a year. Do we need to be offering coverage monthly?
Yeah, I get this question a lot, and frequently I find this, a lot of times in the operational process of our clients, before they came with us. Yes, the answer is you need to make sure that the offer of coverage covers 95%. So you have employees that become eligible throughout the year. And if you're not making offers, that means you're dropping compliance. So the answer is yes. And then it gets more complex if you have a non-calendar year insurance plans. So yes, you need to offer continuously throughout the year to make sure you're above 95% every month.
Okay, next question. What are some solutions for getting around low participation?
Yeah, again, those are some of the different insurance products that are out there and designed. There are specific carriers and third-party administrators that have designed insurance products specifically for this industry to deal with this exact problem. So these are what we call minimal essential coverage products, and so I strongly recommend that for this type of industry, just due to the logistical challenges and the fact that, again, we see about 92% decline. We never see more than 8% of the workforce take insurance. So that's just a huge, huge risk there. You don't know what these employees are doing. They're all low wage, so they all qualify for premium tax credits. So it's just a big challenge for this industry. They're a huge target by the IRS just due to the nature.
Okay, next question. This is a bit of a long one, so bear with me. Are you seeing that the state exchange systems are notifying employers who are seeking coverage under the exchange? We've found that they are not sending these letters, and there's a disconnect here. Employers don't have an opportunity for due process.
Yeah, that is unfortunate. Yeah, and unfortunately, the way the law was written and the way it should work is when an employee goes and seeks a premium tax credit on a state or federal exchange, the exchange should theoretically send you as an employer a notice and give you 90 days to appeal it at the marketplace level. So if you appeal it at the marketplace level and you're in compliance and you prove, no, this employee was made an offer, minimum value was affordable, then they don't send that information over to the IRS, and you're not having to deal with it at the IRS level. Also, the employee, you don't want the employee getting subsidized health care when it's going to get called back at some point when the IRS reconciles this. So unfortunately, most exchanges have not been sending those notices out. I think California, we're one of the few states. Washington has always sent out notices, but other than that, most states do not send notices, and so you're not getting a chance, and you're having to deal with it at the IRS level. Again, another reason why you want to look at what you're filing, look at your compliance, because you're going to deal with it at the IRS level.
All right, Greg K., it looks like that's all we have for today, so we'll go ahead and end our program. Thanks so much, Greg K., for sharing your obviously considerable expertise Thanks to Trusaic for making this event possible, and of course to our audience for attending. There will be a recording available of the program, and we'll let you know by email when that is posted. Thanks again, and have a great day.
Thank you.